Okay, right. So let's look at part two, and here we're looking at subsequent measurement. We have kind of, oh, sorry, briefly talked about subsequent measurement already, but really here we're just talking about what happens post initial recognition of that initial liability, and it's what you expect for your classic financial instrument, amortization of loan and of bonds. That similar principle. Carrying amount here is literally increased by the interest charge, which is the outstanding liability multiplied by the discount rate. And that finance cost is recorded in the statement of profit or loss. So let's see this example here. I'm literally just moving step by step. So I can use a tabular fashion or double entry, it doesn't really matter. This question, in the first video, I was working out what the present value was, but here I'm given the present value. So the present value of the lease payments, if you like, is 57110. So it says Riyadh entered into an agreement to lease an asset. Terms here. So the primary period, so 4 years from the 1st of January, and with the rental payable at the end of each year. So really what we're saying here is that you have a lease liability. So that's my lease liability starting off with 5710. So what's going to happen is interest is going to accrue. So I'm going to have a finance cost of, it's 15%. That's what's implied. It's sort of, it just falls out. It's just what it is. Based on what I know I want at the end. So here I'm saying I'm going to pay 2,000. I'm basically saying that, listen, I want to pay 2,000 each year for 4 years. So that's kind of 8,000. So I'm saying, listen, I want to borrow 5,700 and pay you 8 grand in 4 years. Well, 8 grand over 4 years. So we can work out what is in the interest is implied. The interest therefore is 15%. It's kind of worked out by knowing what the final value or the total payments will be compared to the initial. Compared to, yeah, that sort of, which is the present value of that. Okay, great. So, where are we? Here we are. So we start off with this sort of 15%. So we do 15% on the 5710 because I'll take you to the illustration in a second. We do 15% of this 5170, record that as a finance cost, of course, and then pay off the 2,000 out of the bank. Here we have bank 2000. And so this falls, doesn't it, every single year. So I can do it now. Let's just randomly do it. 15% of 15% of 5710, which is 856. So you will have 856 here, and the finance cost here is 856. So you pay up to 2 grand, and so you have a carried down figure, don't you? So you have the 571 856 plus the 5710 minus the 2 grand brings us down to a carried down figure of 4566. So we have that brought down, and we start the whole cycle again. You do the 15% of this, take off the 2 grand, and you keep going till you get to the end. So let's just look at what the tabular version looks like. Keep here, and we have a tabular version. I'll take you to that. Here we are. So this is what I was saying. Well, in terms of the depreciation, it's just the 4 years depreciate each year, straight line. It's the liability one that needs that tabular fashion. So there we are, 571, add on interest, take off 2 grand, carry down. Do the same thing again, 54567, do the interest, take off 2 grand, and you keep going, and you will see that that interest is really the difference between the 5710 and the 8 grand. And this is a standard way of looking at this, isn't it? So in terms of what we show in the income statement, which you get asked, get asked what the depreciation cost is. You put that through, which is the dividing your right of use asset by 4 years. Then we have the finance cost. We put that through, of course, 857. And then in terms of what we recognize in our statement of financial position, here's our liability. So the question here is, this is the full. We are required to recognize what your liability will be over the next year. How much are you going to be paying over the next year? Well, when I say how much do you owe, will you owe? So interest will accrue of 685, but you're going to pay, if you like, 2,000 minus this 685, and so this 2,000 minus 685 will be your kind of current liability. This is what we believe will be leaving you over the next year, if you like. And so you now have here the difference whatever's left. So the 3252 is what you will now owe after, if you like, another year. But at least for the coming year, it's the difference between these two, which is really the difference between these two. I mean, it's 2000 minus 685, which is the same thing as 4567 minus 3252. So that's your so we always split, if you like, the liability into a current liability, if you like, and your non-current bit of 3252. Yeah, I mean, it's a bit like saying that. I mean, just to give you one final way of thinking about this as well, it's like saying, listen, I intend on paying 2 grand. So of course we would like to write 2 grand there, but you have this interest of 685 that interrupts and sort of affects what it is you're really paying. Imagine you were just paying 2 grand during the year, because sometimes if you're paying 2 grand at the beginning of the year and this interest will accrue at the end, well, then that 2 grand is what it is you're going to pay for the year, and that will be your current liability, because that's what you're going to pay. But where you have the scenario where you intend on paying 2 grand, but it's going to be affected by the 685, the 685 eats into this 2 grand. So in effect, you're really only paying, if you like, 2 grand less that, because it's covering that 685 as well. So it's not a full 2 grand. It's really 2 grand less the 685. And that's how we deal with that, really. Yes, and that's how we sort of deal with that. So I think what I can do here is in this section as well, look at short life assets as well. So we very quickly just looking at this. So far I've been talking about this idea of these leases. Well, of course, if you have anything that's a 12-month sort of relationship where you're taking something and you're going to be using it only for 12 months or less than 12 months, if you like, and it is of a certain or stroke and doesn't really matter, of a certain low value. Well, it says, I mean, think about it, 12 months, less than 12 months, it shouldn't really be a lease. It's just really an expense. You know, you barely own the thing if you're only using it for less than 12 months. So really, you can recognize this kind of like how I spoke at the beginning of the class. Just very much, if it's less than 12 months, I mean, it might be more than 12 months, but if it's a low value asset, then recognizing it as a lease is, you don't have to. The standard says you can just recognize it like a normal expense, if you like, over the period. So when we talk about low value type assets, we're talking about computers and telephones, and there is a figure, I believe it is about 7 grand. I think it's 5 to 7 grand. Where if it's less than this, you don't have to recognize it as a right of use. And so in this scenario, you don't recognize. You see, it says here, no lease liability or right of use would therefore be recognized. Recognized. Forgive the spelling there. Yes, sorry. It says yes, 5,000. 5,000 is a guide. It just gives it as a guide, right? And that's the thing. So just showing you what that is. It taking you to the text. Yes, they talk about that there. So they give you some examples: tablets, small personal computers, telephones, small items of furniture. And cars, no, because even though a car might be, you've used the car for a long time and it might have a low value, it wasn't, it was new. When it was new, it wasn't of low value. So we're talking about things that even when they're new, they have low value. Right, and these are these things definitely less than 5 grand. So you can just recognize them as expenses. This is a good example here, just so you can see it. And I won't cut it out, but it's sort of saying these people have a 2-year telephones, 2-year lease, treating it as a normal expense, and we must accrue evenly. So the terms of the lease require an initial payment of 2 grand, followed by 2 payments of 8 grand over the next 2 years. So if I'm treating it as a normal expense, it means that the total rental is 2 plus 8 plus 8 divided by 2 years. So that's 9,000 each year. And that's because they're telephones. So telephones, computers, that sort of thing. So 9,000 each year. That's the plan. And just treat it like your normal expenses. Just treat it like that. So I'm expecting 9 grand over a year. But 1st of April 2006, it's telling me the year end is the 31st of December. So 1st of April to the 31st of December, I should have 9 months of 9 grand in there of 6,750. That should be my accrued, that should be my expense. You've paid 2 grand so far. So by December, you need to accrue another 4,750 to get it back up to scratch. So your lease rental payment is 6,750. and you have put through an accrual of 4,750. Yeah, I think with a mid-year, you're just time apportioning everything we've done. You're time apportioning depreciation, you're time apportioning interest, and really, it's literally the same thing. When you look at this question, you're just literally whatever you're doing, you're just time apportioning and just dealing with the payments as you're going along in that order. So I would look at this, just review this, but it's just the same thing. Just follow the order, create your table, pay whenever you have to pay. So for example, here there's an initial balance of 700,000. The question here tells us that you actually paid 200,000 right at the beginning. So if you pay 200,000 right at the beginning, you have 500,000 left, and then you recognize interest for whatever is left, and you have your balance carried down. So it's up to you when if you pay a lot at the beginning, you'll have less interest, and then you just sort of carry on. Just following the dates in order. So have a look at this in your text, but it literally is the same principle of the tabular format, but just respecting the rules of I have the starting point. I calculate, well, if you pay principal off first, pay some principal, then calculate interest, or are you accruing interest and then paying off some principal and interest at the end, and you just do that year on year. So great, and that's kind of what's going on with leases. And yes, I'll see you in the final video for sale and leaseback.